Myself, Dr. G. Swarnalatha, Department of Commerce with Computer Applications. The topic which I am going to deliver is credit control by commercial bank. We can see the process of credit control by central bank. A central bank possesses a number of instruments for controlling credit money. These are of two types, quantitative and qualitative. Quantitative technique seeks to regulate the total quantity of credit, while qualitative measures affect the availability of credit. Bank rate policy. As a bank, a central bank lends money or discount the bill of commercial banks. The rate of interest charged by the central bank is known as a bank rate or discount rate. Manipulating bank rate. Central bank can regulate the credit creating power of member banks. The next one is if the bank rate is raised by central bank, commercial banks are to borrow at a higher cost. Then they will increase the lending rate. This rate is known as the market rate. The difference between market rate and bank rate is the profit margin of commercial banks. When bank rate rises, market rate also rises and vice versa. The demand for bank loan will reduce. On the other hand, for credit expansion, bank rate is reduced. Effectiveness of this technique depends on the extent to which commercial banks also depend upon this. If banks can collect funds for other sources at relatively cheaper rate, they need not depend upon the central bank credit. Again, if investment opportunities are not present, the market demand for credit will weak. A fall in the bank rate may rise at the level of bank credit. Open market operations. It implies purchase and sale of securities in the stock market. When the central bank appears in the market as a seller of government securities, people buy such securities by withdrawing money from banks, or banks themselves invest in such securities instead of granting loan to public. In case, the powers of creating credit will be restricted. On the other hand, the central bank may buy a securities, money will out the enlarging the cash base of such banks. Credit control by central bank. Through the market purchase and sale of government bonds, the central government can decrease and increase the supply of money, but at the same time the effective rate of interest of the government bonds gets changed automatically, which the central government cannot prevent. Suppose the government bond in question bears a rate of interest 10% with a face value of 1000. This implies a yearly return of 100. If the central bank wants to purchase this government bond is unlimited amount for say 2000, the effective rate of interest gets changed to 5% automatically, which was no part of the intention of the central bank. Credit expansion depends upon external business environment, and borrowers' attitudes over have no influence. Variations or reserve ratio. Commercial banks are legally bound to keep a portion of their deposits in the form of cash reserve. It is the most liquid asset in their hand, and at the same time it is zero earning assets. Naturally, by altering the CRR, the central bank can expand or reduce the funds bank can lend. There exists an inverse relation between the size of the cash reserve and the amount of credit given by a bank, assuming a given amount of deposit. They developed a money market. This technique is more suitable than open market operation or this cash reserve policy. Qualitative credit controls. A central bank also possesses certain technique by which it can control the direction and distribution of credit, purpose-wise, area-wise. The purpose of selective control is the rational allocation of scarce bank credit and its economic utilization. Further, sectional development of credit and controlling to the other directions serve the purpose of preventing speculative activities with the help of bank finance and favoring productive activities. These techniques very helpful in the developed economy where overall credit restriction found growth by preventing the flow of credit for investment. Moral suasion. Moral suasion is the qualitative technique. The central bank requests banks to lend more and not to lend in some sectors. There is no legal compulsion behind their acceptance. Generally, if a request is not carried out by the member bank, the guardian of the banking system may take such step as bankers are forced to accept. The central bank is often empowered to issue directives to member banks. Indirect orders are in the form of directional control, prohibiting loans of particular for giving advice to grant loan to priority sectors. Function, now we can see the functions of central bank. Note issue. The central bank alone is authorized to issue the currency notes in the country. It has the monopoly of note issue as no other bank is permitted to do so.